Are we on?
Yes.
Good, so you can sit down.
Okay, thank you.
So today is the 13th day of February 2024, and we are looking at the legal regime for the taxation of petroleum companies in Nigeria. The taxation of petroleum companies in Nigeria, and our focus today is on what the PIA has done. Basically, we are looking at the position of the Petroleum Industry Act with respect to the imposition of tax on oil companies. We know that the PIA is divided basically into 5 main parts. Part one, or okay, part A. Part one deals with the governance and institutions. Part two deals with the administration of basically licenses, acreages, and all that. Part three deals with host communities. Part four deals with fiscal, taxation, fiscal provisions, and all that. And you find that in sections 258 to 306, 258 to 306. Yes, so essentially what that part provides for, is for the imposition of what we call the hydrocarbon tax. What that chapter, provides for is the imposition of what we refer to as the hydrocarbon tax. Perhaps to refresh your memory, we used to have what we call the PPT under the old regime, the Petroleum Profits Tax Act. Companies involved in upstream operations were mandated and required to pay this tax called Petroleum Profits Tax. On the average, it was imposed at 85%, but like I pointed out, there were some variances. Companies operating in deep offshore under production sharing contracts were later on given some allowances and what we call tax credits, and essentially they paid about 50%. And in the 1980s, when there was a serious slump in the economy because of the nosediving of petroleum revenues, the military government also allowed oil companies through what we call MOUs to pay also about 50%. But basically, PPT was 85%, and it was imposed only on upstream crude oil production, to incentivize companies to produce gas, to invest in gas. Gas was not taxed like crude oil, so companies producing gas were required to pay 30%, basically under the CIT regime, or Companies Income Tax regime, and the law for that is the Companies Income Tax Act. And of course that makes sense because gas was not, and is still not as profitable as crude oil. So to impose a tax rate of 85% would have not really been a sensible idea for the government to have taken at that time. But what the PIA tried to now do is to create two headings of tax, one of which remains as CIT, and then we now have this hydrocarbon tax. Hydrocarbon tax, as you will see, basically applies to companies operating in shallow waters and then on land, what we call onshore, while companies operating in deep offshore are not, there's no direct provision for them to pay hydrocarbon tax. And so our inference is that they will only now have to pay the company's income tax, while companies operating on onshore and in deep shallow waters, in shallow waters, not deep waters, in shallow waters, that is anything less than 200 meters deep. It's more than 200 meters deep is deep water. So any company operating in shallow waters or onshore will have to pay this hydrocarbon tax as well as this CIT. So for them they will be paying about 60 60% tax essentially to the government. Now, perhaps before we jump in, just to point out that Section 258 contains the objectives of Chapter 4. I will run through them, one of which is to develop a progressive fiscal framework that encourages investment in the Nigerian petroleum industry while balancing rewards with risk and enhancing revenues to the government. If you don't design your tax framework properly, your tax regime properly, you may have problems. I've told us severally that Nigeria is no longer the shining star in West Africa as far as crude oil production is concerned. Have I said that? Yes. That before this time, we used to have petroleum being produced. We had just few stars in Africa, that were producing countries: Egypt, Tunisia, Algeria, Angola, Nigeria, and Libya. But today, almost everybody is producing oil. Yes, Uganda is producing, Kenya is producing, and Tanzania is producing, Sao Tome is producing, Ghana is producing, Liberia is producing, Sierra Leone is producing. Everybody has found oil. Not as significant as the ones that countries like Nigeria and Libya have, but sizable enough to attract investors. So, as a petroleum producing country, you are looking for capital and technology to extract your resource. Your fiscal regime must be designed in such a way as to attract these investors. Because if you don't do that, they will simply go to Libya. After all, why am I coming to Nigeria to look for? I just need 3 oil blocks. And Liberia has enough. Some of them have up to 1 billion barrels. Am I coming to take the whole 37 billion in Nigeria? Definitely not. Are you with me so far? Yes. So these are things you have to now also look at. And I think I pointed out that before a country can decide to invest in your client, and they look at several things. Did I say that? Yes. They look at your political risk. They look at the prospectivity of your field. Did I say that? Yes. But perhaps the most important for them is your tax. They look at political risk. They look at the prospectivity of the field. They look at the terrain. Is it in ultra deep? Is it in deep? Is it in offshore? Is it on land? And they look at the infrastructure. Do you have light? Do you have road? What, my dear? Yes, is there security? All those factors will be concerned. So that is the first objective. The second one is to develop a forward-looking fiscal framework that is based on core principles of 1, clarity, 2, dynamism, and 3, fiscal rules of general application. I take it again. To develop a forward-looking fiscal framework that is based on core principles of clarity, dynamism, and fiscal rules of general application. And this law is not clear. There are some areas I told you I've been on this thing. If I was in 6 o'clock till I got up 11:30, there are some areas I can't, it's unclear. And why would you make a law for the common man that only you making the law, you understand? I don't know. For example, you will see in the course of this discussion that they told us that hydrocarbon tax is applicable to crude oil, natural gas liquids and all. When you go to section 267, you will say that hydrocarbon tax is applicable to profit from crude oil. So you begin to ask yourself, what is happening? Now, the third objective is to expand the revenue base of the federal government while ensuring a fair return for investors. The fourth is to simplify the administration of petroleum tax. And lastly, to promote equity and transparency in the petroleum industry fiscal regime. I may ask you in the exam, state 4 or 5 objectives of chapter 4, and you should be able to give me these objectives. So let's say a few things about tax administration in Nigeria, in the Nigerian petroleum industry. You see that again, section 259. We have 3 basic institutions administering tax and revenue generation. My daughter, close the book for now. Focus on Papa. Good girl. My daughter, focus on Papa after you read. Okay, so we have 3 basic institutions. We have FIROS that administers CIT, and administers hydrocarbon tax. Then we have the NUROC, Nigerian Oil Regulatory Commission, that administers the collection of rents and then royalties, fees, and all that. So that is the work of the NUROC. Then we also have the authority for the midstream and downstream that basically collects gas flare penalty for midstream operations. Now, under section 258 sub 2, funds collected from the petroleum industry and due to the government are to be transferred to the federation account in a timely manner. They include, and I go through them, taxes and royalties, production shares, production profit shares, signature bonuses, production bonuses, renewal bonuses, rents, fees, fines, levies due in relation to the grant assignment termination and breach of licenses, leases, or permits. So all these revenues are to be paid to the federation account, and it is from that federation account that we now pay to the host states, and what do you call them now? Petroleum producing states like Bayelsa and the rest of them. You pay them their 13%, and it is from that federation account that you now begin to share this revenue to the rest of the states in the country using what we call revenue derivation principles. Can somebody remind me of any of those principles?
Yes.
Yes, sir. Population, landmass, development,
equality of states,
need, NEED. You know, so a state that has more need, we can give them more money. For example, we now have insurgency in the north. You know, so we want to address insurgency, we give them more money and set up. I think they've set up something called Northeast Development Commission, something like that. Then the last one is derivation. You understand? Derivation simply means that wherever you got a resource from, you give them something in recognition of the sacrifices that they have made. So let's talk about hydrocarbon tax. Let's say some things about hydrocarbon tax. And you see that in part 2 of the Act. Part 2 of chapter 4, that's what I mean. Okay, so perhaps I should just go back a bit to still say that when you look at the chapter 4, which deals with fiscal matters, it has 10, yes, it has about 11 parts. 11 parts. Part 2 deals with hydrocarbon tax. Part 3 to the end deals with hydrocarbon tax and CIT. Are you with me? Yes, so, but if you want to know what is the percentage of CIT, you don't get that in the PIA. You go to this CITA, which tells us on a good day is 30%. Are you with me so far? Yes, but part 2 of the Act deals basically with hydrocarbon tax. So we'll say a few things about hydrocarbon tax. But perhaps before I go into the Act itself, just again to mention that what happens is that before a company will be allowed to pay profits, before you impose tax on a company, the reasonable thing to do is to allow them to make deductions. Is that so? Yes. Yes, deductions. And the expenses that they have made, they should be allowed to deduct them. It's whatever is left that is the tax. They used to ask in church, some people, when they don't want to pay tithe, they'll be asking, if I receive 100,000 as my salary, do I pay tithe on gross or do I pay tithe on net? If you say, okay, pay your tithe on net, it means that the transport, like me now coming to Bayelsa, burning my fuel, 35,000 naira fuel every week, or the weeks I drive down, I will have to deduct all that. Are you with me? Yes, because it's my expenditure now to getting the money. Yes, so if you have set up a business and you want to pay your tithe, you deduct the rent, deduct electricity, and all that. Some pastors, many pastors will tell you pay your tithe on gross. Others will say pay your tithe on net. In the final analysis is between you and your God. So that concept is brought here to say before you pay the tax, the government, because they want to encourage you to continue to do the business, and they recognize that before you got this profit, you will have made some expenditure. So you'll be allowed to make a number of deductions. So as you will see in the course of this discussion, we have allowable deductions, and then we have deductions that are not allowable. Are you with me so far? Yes. So the first thing that the PIA does, and part 2 does, is to provide that companies are going to pay this hydrocarbon tax. And like I said, you see that in section 260, ordinarily, it should apply to crude oil, field condensates, and what they call natural gas liquids that are derived from associated gas and produced in the field of the measuring point, basically in your concession area. So ordinarily it ought to apply to crude oil, field condensates, and natural gas liquids that you derive from AG, associated gas. What is associated gas, my daughter Coco? Good. Please, let's continue. Okay, so section 261, the hydrocarbon tax is imposed on the profits of any company that is engaged in petroleum operations in relation to crude oil. It is charged and assessed upon the profits related to the operations of such companies, and it is paid during each accounting period. There are a lot of definitions that we have to also make so that you'll be able to appreciate some of what we are saying. We have to make a number of definitions. We have to know what is accounting period, what is chargeable oil, what is adjusted profit, what is accessible profit. A lot of these things are complex. I will tell you the ones you should not read for exam. Is that okay?
Yes, sir.
So perhaps for purpose of recording, let me just read section 200 and 261. Is somebody with PIA here in your phone? Read for me. Okay, while you're opening, let me start. Section 260. This part applies to companies engaged in petroleum operations in the onshore, shallow water, and deep offshore. That is my first problem. Because like I said, when you go to section 267, if you can open 267 for me, that will help us. You will see that in imposing the tax, they only provide for onshore and shallow waters. Are you with me? Mm-hmm. Yes. So when you open, let me know. Okay. Good. Read for us 267.
The chargeable tax for any accounting period of a company shall be a percentage of the chargeable profit for that period aggregated, and it shall be a 30% of profit from crude oil for petroleum mining leases selected under section 93 sub 6b and subsection 7b of this act with respect to onshore and shallow water areas, and b 15% of profits from crude oil for onshore and shallow water and for petroleum prospecting licenses selected under section 93 sub 6 sub a and 7 sub a.
Sub a. Okay, so you can see that when you look at section 260, which I just read, it said this part applies to companies engaged in upstream petroleum operations in onshore, shallow waters, and deep offshore. when you read the place where the tax is imposed, section 267, they make the reference to shallow waters and what? And onshore. So that becomes my first issue with the with the imposition of hydrocarbon tax. Secondly, please just flow with me. 260 subsection 1A says hydrocarbon tax shall apply to, listen, crude oil as well as field condensates, liquid natural gas liquids derived from associated gas and produced in the field upstream of the measuring point. When you look at what the young lady just read, 267 again, you will see that the chargeable tax for any accounting period shall be a percentage of the chargeable profit for that period aggregated, and it shall be 30% of the profit from crude oil. What about the gas you talked about? That is my second issue. But let's continue. No law is perfect as long as it's human beings that made it. But we should limit the mistakes. Now, if you look at sub B, 260 subsection 1B, let me just read. Hydrocarbon tax shall not apply to, number one, associated natural gas, that is what we call AG, including gaseous natural gas liquids produced in the field and contained in the rich gas and non-associated natural gas. Two, it shall not apply to condensates and natural gas liquids produced from non-associated gas in fields or gas processing plants, provided the related volumes are determined at measurement points or at the exit of blah, blah, blah. You know, like I've always said, under the old regime, companies that produce gas were required to pay only CIT 30%. You remember?
Yes.
They have no business with PPT. Now we are throwing away PPT. And we are saying we are bringing HT and CIT. But we are still retaining that same principle to say that if you are producing gas, you have no business with paying this, what is this called again? Hydrocarbon tax. Except, please listen, except it is what they call field condensates or liquid natural gas that is derived from associated gas. So when we talk about associated gas, you have gone to produce crude oil. Are you with me? Because what we are imposing hydrocarbon tax on, or let me call it HCT, hydrocarbon tax, HCT, hydrocarbon tax. We are imposing HCT on crude oil. But in the course of producing that crude oil, you now found associated gas. The same expenditure that you use in extracting the crude is what you have used to get the associated gas. If you now capture that associated gas, compress it, out of it you now bring what they call condensate. Condensate is basically a derivative from gas. Are you with me? My wife was trying to explain it to me this morning that we have these hydrocarbons. They have different forms of density. Asphalt, bitumen, those ones are very heavy. Then we have crude oil, which is also thick. Then gas is extremely light. You know that? You know. So there's a way they will, these engineers will work on that gas and something will come out of it. It's condensed, actually. That's what we call condensate. It's like water, it's like liquid. It's extracted from gas. The Act is telling us here that the condensate or the natural gas liquid that you extract from that associated gas, you will pay HCT on it. But if this man now goes to a non-associated gas fields, because we have fields that don't have associated gas, what we have there is gas. In countries like Kazakhstan and Russia, you have massive gas fields. Even in Nigeria, what we have in Bahrain, for example, those are massive gas fields. They may not have crude oil there. If you go to that gas field and you invest your money in breaking that ground and extracting the gas, and you condense it, are you with me? Or you are able to produce what they call natural gas liquids from that gas which you got from a non-associated gas field, that one you will not pay hydrocarbon tax, because we are encouraging you to do such investments. The only thing you will pay is what? CIT. Let's continue, please.
Excuse me.
Yes, brother.
The condensing
Yes.
you mentioned is it not fuel?
Is it?
Is it not fuel?
It's fuel. All these things are fuel. Crude oil is fuel. Gas is fuel. They are all fuels, you understand? But they have different technical names for them. The one me and you used to start our car, they call it PMS. It's a premium motor spirit. It's a fuel.
I think
Yes,
I think that one is fuel. Like the one you
It's fuel, of
normally
course.
use to start the car
Yes.
is the one they refine already.
It's refined.
But that one, the condensate is not refined.
Mhm.
It's not refined. It's highly flammable.
Yeah, I don't know whether it's refined, but I know it has been compressed. Are you with me? Gas is not like crude. Crude is something you can even use your hand and pick
Yes.
from the ground. Gas is more or less like air, but inside of that air, we have all manner of chemical properties. Once you capture it, the pressure is very high. So engineers have to now do a lot of things with it so that they can properly store it. In some instances, they liquefy it. That's when I talk about LNG, liquefied natural gas. They can reduce that gas to liquid. That's when I say gas to liquid, natural gas to liquid. They can also condense it. Are you with me, sir? And they have different engines that can use. You cannot take an engine that can operate on one to use for another one. That's why if you want to now start using our cars, to use gas for our cars, they have to do some work on the car. Is that not so? Yes. So basically, that is just to emphasize some things. Please, let's continue. Again, so I said we'll talk about some definitions, accounting period, and then all that. Now, another thing the Act now does for us, after providing for companies to pay these taxes, it now tells us how do we ascertain, how do we come to a conclusion on what is to be paid by the oil company at the end of the accounting period. And for that, it tells us, first of all, there's a terminology called the adjusted profit. I have sold crude oil 100 naira. I mean, I have used 50 naira to get crude oil. I've sold it for 100 naira. Are you with me? So I now have 100 naira in my hand. The law allows me to adjust this profit by making some allowable deductions. Having made those deductions, what I will arrive at is called my adjusted profit. But that is not all. The law now also allows me to say from these adjusted profits, if I had made losses, for example, I made loss last year, the law gives us a lot of allowances. This year I did not make any loss. I put 50 naira, I got 100 naira. I have 100 naira in my hand. But last year, I put 30 naira. And what I got in the end was 20 naira. There's a loss of 10 naira. Is that so?
Yes, sir.
Yes. The law allows me to assess that, to make some of those deductions in order to arrive at what we call assessable profits. Are you with me? Yes. So we want to now look at them. For that, let's start with section 262, please. We'll do a lot of reading today as much as we can. Because we are doing recording. Next year I may not be here. I will not have time to sit down to teach. I will tell the students, go and listen. Okay, so 262, my daughter read for us.
Section 262, sub 1. Subject to this act, in relation to any accounting period, the crude oil revenue of a company for that period shall be the value of any chargeable oil adjusted to the measurement points based on the A, proceeds of all chargeable oil sold by the company, and B, value of all chargeable oil disposed by the company.
Yes.
Sub 2.
Okay, go on.
For the purpose of subsection 1, the value of any chargeable oil disposed of shall be regarded as the aggregate of the value of that crude oil determined for royalties for all fields in accordance with this act.
For any applicable law. Very good. So you can stop now. So the first thing we are saying is that what are we taxing you for? What are we taxing you for? We are imposing tax upon you because you are producing crude oil. We are imposing tax upon you, number one, for the proceeds of all chargeable oil that you sold. If you produce oil in Nigeria, that oil is subjected to tax. Whether you produce the oil lawfully or unlawfully, if you produce the oil unlawfully, we did not give you a license, you enter the ground and took the oil and we arrest you. That is different. The profit you made while producing the oil illegally still has to be taxed. That oil that you produce is called chargeable oil. Are you with me so far? Are you with me?
Yes.
So the crude oil revenue of a company shall be the value of any chargeable oil. What then is the chargeable oil? We are saying, number one, we are looking at the proceeds of the chargeable oil that you sold. So you produced 10 barrels of oil. You sold 9 barrels to Coco for 1 million naira. That money is subjected to tax. The remaining 1 billion, the remaining $1, you did not sell it. You gave it to your brother Wanko as a gift. You have to still pay tax for it. So for that one, you did not sell it. So when I say the value of all chargeable oil that you disposed of, you gave it to somebody, you used it yourself. Are you with me so far?
Yes, sir.
We must now look for a way to get the value of that chargeable oil that you disposed of, and then we shall impose the tax. Then, how do we determine the value of the chargeable oil that you dispose of? It shall be regarded as the aggregate of the value of the crude oil that is determined for royalties for all fields in accordance with this act or any applicable law. Are you with me so far? Are you with me so far?
Yes, sir.
We will talk about royalties and rents when we meet on Thursday, God willing. Another thing you now need to understand, I said it before, let me reemphasize this. Section 262 sub 3 now tells us what is your adjusted profit, because you have now sold the oil. But I said you're allowed to adjust it. The adjusted profit is that thing in your hand that you are ready to talk to the government with after you have made some deductions. So section 262 sub 3, subject to section 2662 of this act, the adjusted profits of an accounting period shall be the profits of that period after you have made the deductions allowed to you under section 263 sub 1. Are you with me so far?
Yes.
Yes. So now let's look at those deductions before we go to the next one, accessible profits. Let's look at those deductions, because I could ask you in the exam to give me 5 of them. That should be easy. So see section 263 sub 1. Victory Smart, can you read for us quickly?
Sub 1. In computing the adjusted profits of a company in upstream petroleum operations related to crude oil for any accounting period, there shall be deducted expenses wholly, reasonably, exclusively, and necessarily incurred during that period for the following, including but without otherwise expanding or limiting the generality of A, rents incurred by the company for that period pursuant to a petroleum mining lease or a petroleum prospecting license. B, all royalties.
So number 1 is rents. Are you with me?
Yes, sir.
Remember that the deductions must be expenses that you wholly, completely, reasonably, exclusively, and necessarily incurred. So these things are very important. You say, I used it, I incurred it in the course of operation. Was it a reasonable expense? Are you with me? I bought an oil rig for 1 billion. I want to deduct that expense. But oil rigs are being sold for 100,000. How do you go and buy your own 1 billion? The government will challenge you on that deduction. That's why we use victory. Do you understand? That's why we use the word. To the fact that it is wholly, exclusively, My daughter, sorry, you can stand a bit. Are you okay? Though, God bless you. You can stand a bit. Okay, so please look up. The fact that it was wholly, exclusively, and necessarily incurred is not enough. PIA now tells us it must also be reasonably incurred. Before this time, oil companies, when you filed actions against them, they will go and bring lawyers from Lagos and pay them humongous amounts. The question you ask, is it a reasonable expense? Is it a reasonable expense? An oil company staff is going to Abuja for a conference or for work-related matter. You put him in Transcorp. Is he a mid-level staff? Is he a managing director? Or is he an ordinary, maybe level 5 staff that probably you could have put him in a place and pay 50,000? You go and pay 500,000 and per night. Is it a reasonable expense? Are you with me so far? So the tax man has to look at all these things critically. My daughter, go on. All royalties.
All royalties, the liability for which was incurred and were paid by the company during that period in respect of crude oil and associated gas, and where a petroleum mining lease includes payments to the Federation account related to production sharing, profit sharing, rig service contracts, or other contractual features under a model contract, and the company has incurred liability for such payments in kind or in cash. C. Expenses directly incurred for the repair of plant, machinery, or fixtures employed for the purpose of carrying on production activities.
It's okay. So you see expenses incurred for the repair of plant, machinery. Are you with me? Yes, you're repairing. Go to the next one because of time. Expenditure.
An expenditure, tangible or intangible, directly incurred in connection with the drilling of the first exploration well and the first 2 appraisal wells in the same field, whether the wells are productive or not, provided that subsequent exploration wells, appraisal wells, and other wells shall be treated as qualifying drilling expenditure under the 5th schedule to this act, and where a deduction may be given under this section in respect of any such expenditure, that expenditure shall not be treated as qualifying drilling expenditure for the purpose of the 5th schedule.
Okay, go on.
E. Any amount contributed to a fund, scheme, or arrangement approved by the Commission for the purpose of decommissioning and abandonment,
Yes.
provided that the surplus or residue of the fund shall be subject to tax under this act at the end of life of the field, where such surplus is returned to the lessee. F. All sums.
So contributions to a fund, scheme, or arrangement for the purpose of decommissioning and abandonment. We'll talk about it before I release you. A company, for purpose of environmental protection is mandated. I think I've said that, to contribute money to a fund, yes, so that in the end of the life of your lease, if you are not ready to decommission properly, the government will say, no problem, you have money already, I'll take your money and use. So all those funds that you contribute are deductible for tax purposes. Go on, my dear.
F. All sums of the liability of which was incurred by the company to the federal government or any state or local government council by way of
Levies, stamp duties, and fees. So levies, not fine. You will see that fines are not. A fine is a punishment. It's not deductible. Are you with me?
Yes.
But a levy, a stamp duty, and a fee is deductible. Go on, my dear.
G. Cost of gas reinjection wells which are reinjecting natural gas that otherwise would be fled, subject to the ratification of the Commission.
Good. So you have reinjected gas back. Remember that the original policy from the AGRA, Associated Gas Reinjection Act of 1979, the policy framework then was reinject back. I told you it was very expensive. The focus is, we're not looking at reinjection, we're looking at what? Commercializing. Yes, but the law still tells us that if for any reason we are allowed you, that's what it says, subject to ratification by the NURC, if we now say, okay, that field, reinject. All the money you spent in reinjecting the gas while you're taking the crude oil, you can also deduct it. Go on.
H. Any amount contributed to any fund, scheme or arrangement approved by the commission pursuant to the establishment of
You can sit when you want to sit up. The way you stand, like that, they punish you. Eh? Okay, go on.
Post Communities Development Trust under Chapter 3 of this Act,
Mhm.
Environmental Remediation Fund, Niger Delta Development,
Etc. So basically contributions. You make contributions to host community. Are you with me? Contributions to host community. So you can see that in the long run, it's actually the government that is actually paying us the 3%. Because the oil company can still go and deduct it. I don't know if you understand. Yes. So environmental remediation fund is not the company that is actually incurring it. If it can go and deduct it, decommissioning and abandonment is still the company, it's still the government that is paying it. I don't know if you understand. Yeah, because you are allowed to make a deduction, NDDC and all that. So, yes, my daughter, I think basically is that all?
Yes, sir.
Yeah, just to point out, if you look at subsection 2, just to point out that I'll read a deduction allowed in respect of a liability which was waived, released, or recovered shall be treated as an income of the company for that accounting period. What we are trying to basically say is that you have come to FIRS to say I'm allowed to make deductions of my liability. I'm operating in Omok and I paid 1 million naira as rent, access fee, all those small rents, small fees they used to levy. I paid 1 million. Then I paid 20 million to River State government, the security fee. You know, there could be a lot of payments. The law is saying that if that fee that you paid, which is deductible, those are, is subsequently waived, the Omok local government now say we waive that one for you, then we'll treat it as your income. It makes sense now. Yes. The waiver could be done 1 year later or whatever. So just please note that. So after you have made these deductions, what you will arrive at is your adjusted profit. It's your adjusted profit. That's what we're trying to say. But it's not every deduction that you're allowed to make, so that you don't run the government amok and to the ground. If the expenditure was not wholly, reasonably, exclusively, and necessarily incurred for the purpose of petroleum operations, then you will not be allowed to deduct it. I don't know if you understand.
Yes, sir.
That is the first thing you need to understand. So an oil company operating in Shell now decides to give scholarship to injure people. They decide to, Nigeria is playing match. They decide to sponsor the match. Is it linked to petroleum operations? No. Nigerian players, they went to Ivory Coast and they won the match. And they came back with cup. Shell said, you guys have done well. For everybody who went to play that match, we give 20 million. Honorary, is it deductible?
No, sir.
No, those are the kind of questions I can ask you. And they are very simple. Once you know the law, the lecturer cannot pass. No matter where he wants to come from, he will catch you. Are you with me? But if you don't know the law, you just see one little thing, you start to write your own. In the end, and you say, but I wrote much. The HOD of one department, I won't call it since I'm on record. I'm teaching their students one of my course. Students now face, they bought your book, I say, you buy my book, does it mean you know it? But they bought your book, I said, what are you saying now? Don't go and read, say, you're buying my book. You will meet me here next year. Those who did not buy, who read well, they passed one, they had it. Don't consensus me whether you bought my book. The next one, quickly, my daughter.
The deduction from
Yes. You've read the first one, wholly reasonably. If it is not wholly reasonably exclusive, go on 264.
B. Expenditure for the purchase of information relating to the existence and extent of petroleum deposits, other than for the acquisition of geophysical, geological, and geochemical data and information. C. Expenditure incurred as a penalty,
Yes.
natural gas flare fees, or imposition relating to natural gas flare.
Okay.
D. Financial or bank charges.
Sorry, let her come back again. Read that one again, my daughter.
Expenditure
Listen up.
incurred as penalty,
Mm-hmm.
natural gas flare fees, or
Yes.
imposition relating to natural gas flare.
Yes, so you can stop that. So you remember I was telling you, I gave you that case now, Moby versus what?
FRO.
Yes.
FIRS.
FIRS. You know, so I pointed out that these companies, having paid the penalty for gas flaring, they used to go back to government to deduct it for, and now the law is very clear. Though that even before the law, that decision said you can't. If it is a fine, you can't deduct. But now the law is very clear. If it's a penalty for flaring, you can't deduct. If it's a fee for permission to flare, you can deduct. The fee is not a sanction; it is an authorization. You know, so you can deduct. Okay, please let's continue. Go on, daughter.
D. Financial or bank charges, arbitration and litigation costs, bad debts and interest on borrowing. E. Head office or affiliate costs, shared costs, research and development costs, or any other like shared indirect production costs. F. Production.
Yeah, sorry, say head office or what? Let me come back to him
Head
again.
office or
Mhm.
affiliate costs.
Yes, now
Shared,
share, go on, share
shared
what?
costs.
Let me explain. This happens a lot, just possibly. Like for example, now we have SPDC. I like to use them because that is the main company we deal with, and it's close to us here. SPDC now has a number of subsidiaries. They're all in the Shell group. We have we have Daystar. For Nigeria, we have SPDC, we have SNEPCO, we have SNG. These companies are all independent. Under company law, they are separate legal entities. But for purpose of ease and functionality, they used to also share a lot of things. They share offices. SNG staff, for example, now, they operate from SPDC. SNEPCO staff, when they come to Port Harcourt to operate, is from SPDC. If SPDC staff go to Lagos, it's the same office that SNEPCO staff are using that they use. If SNG has a legal issue and they need legal advice, SNG does not have a legal department. It's SPDC lawyers. Are you with me?
Yes.
And so the law is now telling us here that head office or affiliate costs. So the head office now is in Port Harcourt, Shell IA. Are you with me? Are you with me?
Yes, sir.
The money now that SPDC is paying to Rumobiak and the community, let's assume they are paying annual rent for that large tract of land. That money is what we call head office or affiliate costs. Are you with me? Or shared costs and all those things you don't deduct. R&D or any other like shared indirect production costs are also not deductible. Go on to the next, my dear.
F. Production bonuses, signature bonuses paid for the acquisition of rights in
Yes, you
or
don't.
over petroleum
Yes,
deposits.
I have paid production bonus to NURC. I cannot go to FIRS to say I want to collect it back. It's not allowed. Bonuses or fees paid for renewing PMLs, PPLs, or marginal fields. Fees paid for assigning rights to another party. Tax imputed into a contract or an agreement or on a net tax basis and paid by a company on behalf of the vendor. Capital withdrawn or sum employed or intended to be employed as capital employed in improvements as distinct from repairs, sums recoverable under an insurance or contract of indemnity, except an amount that is not recovered under the scheme, rent or cost of repairs to any premises or part of premises not incurred for the purpose of those operations, amounts incurred in respect of tertiary education tax, and CETA, profits tax or other similar taxes, whether charged within Nigeria or elsewhere. And lastly, I think that is the last one, no. The depreciation of any premises, building, structure, works of a permanent nature, plant, machinery is not deductible, and there are a number of them. Payment to provident savings, widows and orphans or other society scheme, you don't go and deduct it. And any contribution to a pension, provident or other society scheme or fund for production, for production staff, yeah, which may be approved with or without retrospective effect, blah blah blah. So please, I want you to take your time and know them. The first thing you need to know is that the tax is imposed on oil companies for crude oil that they sell or crude oil that they deduct. But having sold, that they dispose of, the value of what it dispose of. So it is, okay, that 1 barrel of oil, I didn't sell it, so I'm not paying tax, no. But you gave it to your brother to use. What is the value? So the FIROS will have to determine the value. Are you with me so far? That is the first thing you need to know. Secondly, before you pay this tax, I want to allow you to adjust your profits. That is the next thing you need to know. So adjusted profits is arrived at after you have made your allowable deductions. And the thing you should get at the back of your mind is that you are allowed to make deductions for expenses that you reasonably, wholly, necessarily, and what's the other one? Exclusively incurred for producing petroleum. When you know this, for purpose of exam, for those of you who like to read for exam, you can know 5 of them and put it in your hand. That should be enough. I won't ask you to state more than 5. Then you need to also know that apart from these allowable deductions, the company will still make other expenditure. We allow them to come and deduct, or if we would allow them, then there will not be anything like tax now. Because you can even say your mama where you bury, your MD, like Access Bank now has lost their MD. Very tragic. He was one of the champions of the Niger Delta. But very sad. Access Bank now, maybe they want to bury him now. The expenses they will incur, you can't go and deduct tax now. It's not right. Are you with me so far? Are you with me? Yes. So if it is not wholly, necessarily, reasonably, it's not allowed. You should know that. And I may ask you in the exam, a company has made deductions for an expenditure that is allowable, but there was no reasonableness. And I could give you a scenario that should make you know that it is unreasonable. Are you with me so far? Yes, that this expenditure is being sold for 1 million naira, but this company went to buy it 20 million naira without negotiating. In fact, when they even told them 20 naira, the company said, "Well, even pay more." They now paid 40 million. They want to deduct. What do you think? You should be able to tell me that that thing is not allowable, even though it is necessary, even though it is exclusively, even though it is wholly, it is not allowable because it is not what? Reasonable. So once you do that, you now arrive at your adjusted profits. Are you with me so far? But that is not all. The law still allows you to make some other deductions before you can now come to your accessible profits. Tarila, you want to see your accounting input here. You will tap your brain. We want to hear you give us some of your experiences. Okay. As you are teaching, anything that you see that is similar to some things you have done in the course of your work as an accountant. I saw one man in Kayama. You're from your family, one of your senior cousins. Okay. Yes. Okay, let's move on. Just a second. Okay, now 262, my daughter. Please read 262 for us. Subsection 4. What is the accessible profit of the company?
The accessible profit of an accounting period shall be the adjusted profit of that period after any deduction allowed by section 265 of this act.
Good. So having arrived at your adjusted profit already, you are still allowed in some instances to still make further deductions. It is when you have made those further deductions, if any, it's not compulsory, that will now arrive at the money that they are going to assess for purpose of tax. That's what we call accessible profit. Are you with me so far? And basically, we are looking at losses, section 265, losses. For petroleum law, the law, government is very, very generous and magnanimous. The government does not say, Oga, you invested 3 billion last year. You did not find oil. That 3 billion is gone. This year you made profit. We'll tax you. Government still allows you. So in this year I made 7 billion. But last year I made 3 billion loss. Government allows me in this year, having adjusted my profit, to still go back to last year and make what? Deductions. Are you with me?
Yes,
Yes,
sir.
of those losses. When you have made those deductions alive, but what government tries to do is that in some instances they will not say, they will allow you to spread it. One page, you understand? You will not say the whole 3 billion, no, you can spread it. So if it was 3 billion made as a loss last year, government may allow you to spread it over the next 5 years. So this year you pay 600 million or whatever. Next year 600, so 6 times 5 is 30. Do you understand? So let's look at section 265. Already, I hope you are flowing with this class.
Yes, sir.
Good. 265, my daughter, Vicky, you are teaching with me today.
The assessable profits for each company of petroleum mining lease for
Mm-hmm.
any accounting period shall be the amount of the adjusted profit of that period after the deduction of the amount of any loss incurred by that company during any previous accounting
Any
period.
previous accounting period. Go on to sub 2, please.
The assessable profit shall be determined separately for each of the two classes of chargeable tax identified in section 267 sub A and B.
Good, now I can stop. So the assessable profit, you will determine it separately for each of the two classes of chargeable tax. And provided for in section 267. And what does 267 say? 267 simply tells us that if Honoré is given a PML, petroleum mining lease, he will pay hydrocarbon tax of 30% for onshore or shallow waters. If at the same time we gave him a PPL, the petroleum, what is that thing called? Prospecting license, he will pay 15%. So in either case, having adjusted his general expenses, he has made adjustments of his profits by making those allowable deductions. Now he wants to arrive at the assessable tax that the government will impose. He is now deducting his losses. For doing that, he has to do it separately. These are the losses I made for the PML, separate concession. These are the losses I made for the PPL, separate what? Concession. So the assessable profit shall be determined separately for each of the two classes of chargeable and tax. Coco, are there questions, my dear? None for now. Okay. Let's continue, please. Read subsection 3.
A deduction allowed under subsection 1 shall be made so far as possible from the amount, if any, of the adjusted profit of the first accounting period after that in which the loss was incurred, and so far as it cannot be so made, then from the amount of the adjusted profit of the next succeeding accounting period, and so on until such loss is fully deducted.
Good. So the deduction shall be made so far as possible from the amount, if any, of the adjusted profit of the first accounting period after that in which the loss was incurred. And so far as it cannot be made, then from the amount of the adjusted profit of the next succeeding year after and the next succeeding period, and so on. Okay, another thing I want to point out is that the losses may be deferred to future accounting periods. The losses, you have the freedom not to deduct the losses. You made a loss this year, next year you made a profit. You have the freedom to defer the deduction of that loss to a future accounting period. Are you with me so far?
Yes, sir.
Yes, and of course this will probably come as a result of your discussion with FIROS. Because if you have made profit this year and FIROS say, okay, you made profit, give us money. Say, sorry, last year I made loss, so this year there's zero. That will not be good for the country. Are you with me? Because the country needs the money now. So the government will say, okay, since you made loss of 100 naira last year, please deduct 50 for this year so that we too can have something. I don't know if you understand.
Yes.
The next year you can spread it or something like that. That is what we are trying to say. Mwakwe, you want to add something at this point?
No, usually what happens is,
Yes, please.
I think what they are talking about is for the accountants, we call it loss relief.
Okay.
And you are entitled to loss relief where you made a loss in the
Yes.
previous year or prior year, and you make
Let me write
subsequent
it down. Loss
profits.
relief.
Yes.
Sorry, sir. Go on.
Where you make subsequent profits.
Yes.
You are entitled to those reliefs, and by the law,
Yes.
you can relieve it indefinitely.
Okay.
And the meaning is that where you, let's assume that you have a 50 million naira loss, and then this year you now make 20 million
Yes.
as profit.
Yes.
You won't be able to relieve the entire 50.
Yeah.
So what you do is you relieve this year, and then you also relieve until you're able to make good those losses, the entire
Excellent.
50 million.
Very
So
good.
it's not, before it was restricted to 4 years,
Okay.
where you can't relieve it over 4 years,
Yes.
then it's deemed to be lost.
Okay.
But now it is being done indefinitely.
Wow, I think that's why they use the word any accounting period. I think that is the reason why.
Yes.
Because it is in there. Because I was also thinking, if you say any accounting period, are you saying the one that happened in 1970? That is serious. My question is, what if these losses had arisen as a result of your own negligence? Should we allow you to deduct them? You suffered loss this year because of some accidents that probably wouldn't have occurred if you had applied the best practices, best standards in your operations. I don't know if you understand. And now we have suffered losses of very poor business decisions. Should the populace, should the government have to bear that brunt with you? Tarila, what are your thoughts on that?
Well, I think it is dependent on what has caused that loss.
Okay.
Now, if, yes, you take decisions, and that will result into maybe incurring some expenditure.
Yes.
So where you incur those expenditures, the tax authorities will now look at the expenditure,
Yes.
taking into account whether it was wholly,
Yes.
exclusive, necessarily, or reasonable,
Okay.
or that the expenses was within the allowable expenditures.
Okay.
So if it's within those allowable expenses and it was done wholly, and I think it will go. Otherwise, they will not accept.
Does somebody have something to add? Obaka, I want to say something. Okay. Okay, let's continue. So, Honorable, you now see how we have come to our accessible profit.
Yes, sir.
We are climbing a steep ladder. First of all, we have our chargeable oil, which is the value of all disposed crude oil and the proceeds of the ones that you sold. We have our chargeable oil. But we don't stop there. We now come to our adjusted profits, whereby we're allowed to make allowable deductions. In doing that, we bear in mind that some deductions are not allowed, section 264. We still don't stop there. The law now brings us down to what they call an accessible profit, where you are allowed to deduct your losses. Are you with me? Previous losses. Having done that, we are still not done. We now come to chargeable profits. The accountants, they are confusing us. Adjusted profit, then accessible profit. Yes, sir. And Boemo, now I'm coming. We now come to chargeable profits. Are you with me? So I'll talk on this slide. Then we will now adjust. Tomorrow, I hear because of the swearing in of our esteemed governor, the father of the state, He's the father of the state, whether I like it or not. God has allowed him to be there. We have to give him that honor. Is that not so?
Yes.
I hear there's no work. Gesekberi, is there no work really?
Yes.
Work free. Work free, good. But what I want to do, if it is okay with you guys, we can have an online lecture.
Okay.
If it's okay, so that we tidy up this. Maybe 1 hour, 1 hour and a half. I want to do that for commercial law as well. Then on Thursday, you want to say something? On Thursday, we say some things about royalty, rent, and fees, and then I give you your test, and then we move to next week. Is it okay? You shall send us the link. Thank you for understanding. So we now arrive at what we call chargeable profits. So what is the chargeable profit? So like I said, we are climbing down the steep. So the chargeable profit is the profit of the company after you made the adjustments. The accessible profit is the adjusted profits after you deduct losses. The chargeable profit is the accessible profits. Are you with me? After you also deduct some other things that are allowed, what they call capital allowances and production allowances. So the company has made some serious expenditure in the cost of production allowances, or they have acquired some kind of equipment. Are you with me? We'll talk about it tomorrow. They have made some kind of expenditure. We'll start to talk about amortization. I want you all to go and read these terms. I try to explain them in my slide, but we keep developing knowledge. Amortization, they are all accounting terms. Okay, you are conversant with them.
Yes.
Amortization, depreciation, capital allowances, and there's one other one again, amortization. So just go and read them, go through them. Basically, they are allowances you're allowed to make, particularly when you have acquired some kind of serious capital. Are you with me so far? Serious equipment that you use for your own operation. The equipment belongs to you, but you are using it to do the work for in producing. And over time, that will be depreciating. Okay, is that also?
Yes.
Yeah, it is your own, but you spend a lot of money to acquire it. So I spent 1 billion naira to acquire this. This is what I'm using to produce the oil. But in the next 10 years, the value of this thing may come to this level. The government allows me to do some depreciation. It is around those things we talk about amortization. So I will explain it more tomorrow, and then I will also tap into the brain of our accountants to give us practical examples. Is that okay?
Yes.
Yeah, so we'll adjourn because we have faculty board meeting. Let me go. Thank you for your time. I love you all.
Thank you, sir.
You cannot fit for me, Tarilaye. Is it Tarilaye?
Very nice.
Good.